In financial markets these days, the effects of geopolitics are unavoidable. Whether it's Donald Trump's latest pronouncement on tariffs, war in the Middle East, financial sanctions against Russia or Iran, or export controls on the most sophisticated artificial intelligence chips made by NVIDIA, governments appear to have an almost unlimited ability for, and sometimes appetite for, jolting investors. The uncertainty has become so prevalent that it's almost hard to remember it wasn't always this way. Of course, financial markets have always had to contend with big shocks, but for a long time, say from the late 1980s until at least the global financial crisis of 2008, and probably for some years after that, governments in the developed world broadly tried to woo international capital. The general consensus, known as the Washington Consensus, was that markets do best, trade and capital should flow freely, and governments should focus on providing the legal framework that stimulated private sector activity. Well, that world has disappeared. But how should we think about what has replaced it? And how should companies and investors factor geopolitics into their decisions? Those are the questions we're going to tackle on The Big View this week. It's what we do at Reuters Breaking Views. We tap our best sources around the world for fresh insights into the biggest stories on global business, finance, and economics. I'm your host, Peter Farlarsson. To help us unpick this topic, I've invited Anna Rosenberg onto the show. Anna is the head of geopolitics at the Amundi Investment Institute, which is part of the large European asset manager. Before that, she was co-founder and head of Europe at Signum Global Advisors, the political research firm. And before that, she advised companies operating in emerging markets, including sub-Saharan Africa. Anna Rosenberg, welcome to The Big View.
Thank you. It's a pleasure to be with you.
So Anna, it seems like every corporate and financial situation that we deal with these days has a geopolitical angle. One day there's a knife-edge election, the next day it's tariffs, then it's investment controls, then sanctions, and then from time to time, actual war. When did geopolitics start to become such a significant factor in developed markets?
Well, frankly, the term geopolitics has come up only a couple of years ago. It's not been around for a very long time recently. It's obviously an age-old term, very much linked to great power politics. I would say it started more with political volatility, and I think that probably kicked off in developed markets around 2016 with a combination of Trump 1.0 and Brexit. At least that's how I experienced it. I was a analyst focusing on volatile emerging markets at that point. And suddenly you saw a lot of the political volatility moving basically from those volatile emerging markets to the Western developed markets. And as a result, it then became increasingly important for financial markets. Also, then we had COVID, of course, where it was crucially important to understand how politicians were making decisions, what they were going to deciding. That was very important to predict market movements. And I think since then, and then of course we had Russia's invasion into Ukraine, I think that really then catapulted geopolitics as a term onto the bigger stage. And since then, I think it's become a fixture of financial markets.
So you talked a bit about how earlier in your career you'd spent some time analyzing and advising on emerging markets. What are the skills you picked up then that are sort of now applicable in the developed world? What are the other tricks of the trade that other people have had to learn?
Well, I think that it's really quite fascinating because as I mentioned, I started off actually as an analyst for sub-Saharan Africa, really for markets like Nigeria, Angola, markets that were pretty volatile at that point in time. And then when you saw Brexit hitting, a lot of the clients that I was working with, these were large corporates, right? Large companies like Coca-Cola, Dell, L'Oreal. They were very, very good at dealing with political volatility in some of their most volatile emerging markets. They had big teams there. They were constantly doing scenario analysis, SWOT analyses. They were prepared to deal with currency risks, logistical bottlenecks, supply chain issues, labor issues like visas, etc., etc. But when it hit their biggest markets, they didn't really have those skill sets in their biggest markets. They didn't really know how to deal with these issues in their most developed markets because they didn't have to for a very long time. So I think that's at that point I realized, I know how to do this. I know how to do this. I can help you guys do it, figuring this out in the West, in the US, and in the UK specifically. And really, the playbook is still pretty similar. You need to understand what is actually happening, differentiate noise from real impact. Scenario planning is important. Having, making assumptions as to what is the most likely thing to happen. I think those are the kind of core issues that investors had to learn at that moment in time. And ultimately, this is still the case today, as political volatility is a lot more visible and important today. Those tricks are just very important.
Yeah, I mean, I do wonder about some of the practical aspects of just staying on top of everything that's going on. I don't know how you manage this. I mean, we're inundated with announcements and statements and policy changes. And a lot of the announcements and statements are now also kind of unreliable or incomplete at the very best. Just in terms of your role, how do you decide where to focus and I guess more importantly, or as importantly, what to ignore?
Yeah. I mean, at this point, I think there's a certain element of instinct in there, right? I've been doing this for a while now. Clearly, the first issue is it market relevant? Is it market moving? There are a lot of things happening in the world that are not market moving. And even though they're important, right, they're not what is going to be important for us as a firm. So I focus on the issues that will have a market impact primarily. That's the first lens, right? And then there is a lot of noise nevertheless. What are the things? What is an announcement? What is a statement? What is something that actually is likely going to materialize? And this is where you need to look at it through a lens of constraints. So you need to understand what of these announcements is actually going to happen. Some of them, many of them, are just noise. And I think we can disregard a whole lot of them. And because there are so many obvious constraints that will mean that things are not going to happen. However, the ones that are big shifts, big changes are the ones that we need to pay attention to. For example, I've always was very skeptical about the US pulling out of NATO. This is simply, there was a lot of noise about this and was quite unlikely. Similarly, about the US really stopping Ukraine support. I think that was another, where we saw a lot of noise, but ultimately you have to differentiate between US presidents that come and go and US interests that typically outlast the presidents. And in this case, the interests win. So this is kind of a lens that you need to take. You need to focus at what are the constraints? Is it market moving? If so, to what degree? And then you already get a filter that allows you to focus on some of the most important issues.
Yeah, that's really interesting. I mean, just to sort of unpack some of that a little bit. I mean, I guess the first question to ask is how do we sort of decide what's market moving, what isn't? And do you think markets have got better at reading some of this stuff as time has evolved? I mean, I'm sort of struck that we've had some very significant announcements from the Trump administration on tariffs, for example. Obviously, there was a lot of turmoil at the beginning, but it sort of feels like over time, maybe people have become a bit better at sort of judging. Is he really serious? Is this announcement something that's actually going to happen, or is it a negotiating ploy? I don't know. Do you feel like there's a sort of a muscle being exercised there that people are that they're getting a bit better at this stuff?
They clearly have to get better at it because they're dealing with it every day. So firstly, into what is market moving? That is an important question. For me, I am lucky enough that I sit surrounded by portfolio managers, okay? And I get questions by them. I'm sitting in the calls, I'm sitting in the committees. So to me, what they worry about is what ultimately the market is going to worry about. So that kind of makes it a little bit easier, right? And then of course, what is market moving is usually what's going to affect the big asset classes, the big commodities, the big countries that are very important for the markets. I think that what has changed is that the financial markets audience now has to be a lot more in the weeds on politics than before. They used to be able to say, I don't care about politics. I just need to look at inflation, interest rates, GDP data, economics. That's it. Now they need to understand a whole lot better what is happening. Is there going to be a ceasefire? Is Israel going to attack Iran's nuclear capabilities? What would the implications be? How would this hit Gulf? How likely is it that this would hit Gulf oil infrastructure or even water infrastructure? So they need to understand a lot more the detail and the different scenarios. And here I think they are getting a whole lot better because they have to. It is affecting the market on an ongoing basis. And so they have to know what's going on. And even if the market doesn't always reflect that because it's super strong, while we have this huge amount of geopolitical risk out there, ultimately they still experience the volatility, even if the market doesn't show this up. It doesn't show this ultimately, right? So that's kind of the conclusion that I would draw, that the reality is different from what the market does. The market moves in a parallel reality. And the best I can explain it is that the market keeps on moving in a base case scenario that the downside hasn't materialized. There's a lot more downside risk on everything, but it hasn't materialized yet. So you keep in that base case, and that is quite bullish still. And the same goes for the tariff situation. As of now, not that much has happened. There's a lot of noise. The tariffs haven't been finalized yet. We will only know what the economic impact are when they settle. And that's still quite a while away.
That's really interesting. I mean, I want to come back to that in a minute, but that particular, the sort of the market calm, because that is something that we were kind of constantly struck by. But just, you're talking about the sort of the investment process there, and without giving away any sort of state secrets about how things work at Amundi. I mean, obviously we're used to investors doing sort of quantitative work. You mentioned sort of GDP, corporate numbers, valuations, correlations, etc. I mean, geopolitical analysis is by definition less numerical. So how does it feed into that process? Is there a sort of overlay that says this is all very good, but we're going to avoid this asset class or this country, or we're going to build in a risk premium? I just wonder how it fits into the calculations that are made.
So there are many different layers to it. I think a little bit about it like taking a whole bucket of geopolitical water, if you will, and pouring it over the organization, because it feeds into a lot of different assumptions. Firstly, into economic expectations. We take geopolitical scenarios and reflect them in our forecasts. Okay, so we discuss what's the likely scenario here, how could it affect growth, inflation, if at all, if it doesn't, right? We just always make sure it's reflected. So that's the first thing. Secondly, the challenge that you have is that data is per se all retrospective, versus geopolitical analysis or political analysis has to be predictive. Okay, so this is where the qualitative element comes in. You have to make scenarios. You have to give likelihood to those scenarios. When you give a strong percentage likelihood to a scenario, then a portfolio manager can factor that into their models. Okay, because they have a number. I say this scenario is 60% likely. They have a number that can be reflected into the models. Then we have developed a bunch of different data tools. So for one, we have developed something we call geopolitical sentiment tracker. It measures a whole bunch of risk indicators, and they put this into their models as well for comparative purposes, but also to get an alert if somewhere a level of risk is going up. We've also done a lot of historical analysis. For example, we've tried to understand his geopolitical regimes over time and how they link to economic regimes and what impact of those geopolitical regimes there is for inflation, for growth, for interest rates. And we are trying to then be predictive with this analysis. So I think there are a lot of different ways that you can reflect geopolitics now in financial markets. It's still a new area. It's a new field, and we keep on pushing the boundaries there. But I think there's a whole lot more that can be done.
So just to come back to that question of sort of how this is being factored in, and then what we see in the market. So when you talk about those scenarios, so you would have a particular scenario. I mean, the one everybody talks about is like China invades Taiwan or something like that, right? And then I guess you then assume a load of consequences as a result of that, and then you're sort of putting a percentage likelihood on the whole thing happening, or is it slightly different than that?
You give different scenarios for how a situation like that could unfold, right? Would there be is there a likelihood for an invasion? How high is that? Is there a different way that you could see political maneuvering vis-a-vis Taiwan? What is the most likely? And then you deduct from that economic scenarios. That is one example. I give you another one, a more recent one now with Israel and Iran specifically. Okay. So here, for example, in the scenario that you saw the nuclear attack, you then have to come up with sub-scenarios as to the
attack
impact
on the nuclear facilities.
On the nuclear facilities, exactly.
Yeah.
You then have to deduct from there how likely the counterattack from Iran is going to affect oil flows. And here you then do different scenarios. You can say, okay, we could have the closure of the Strait of Hormuz, which is what be the worst outcome for market. You could have basically nothing happening to oil, or you could have some kind of scenario where you see intimidation of some ships in the Strait of Hormuz. And then you give the most likely scenario there. The highest likelihood goes to what you then think is, because of the constraint, the most likely outcome. And here it was that we didn't expect a major impact simply because it was in no one's interest to happen. So, and this then explains also, I think many analysts came to similar conclusions. This explains a little bit why markets shrugged off this escalation between Iran and Israel, because many analysts came to the conclusion that a major disruption to oil was quite a low likelihood scenario.
I wonder, you talk about constraints, which is very interesting because obviously everybody has constraints, but it does seem to be like we're in part of the shift that's taken place is that we're in a world where governments are no longer thinking primarily about sort of economic efficiency and sort of economic rationality, right? There are other considerations, whether it's security or supply chains or whatever it is, or national defense. So when you're thinking about those constraints, you have to presumably think a little bit about what actually are their priorities as well, and have those priorities shifted from the world we used to be in, where we didn't have to worry about this so much.
Oh, yes, absolutely. I think the priorities have shifted. The constraints are interesting because ultimately you can predict what politicians will be able to do based on the constraints. And they usually are constraints that derive from, first and foremost, and that's the most important one, local politics.
Right.
Local politics is the biggest constraining factor for a politician because their power depends on local politics, right? The second factor is then usually economy and financial markets. And then you go to geography and geopolitics. So there's like a priority list of constraints. We are in a very different world and today, and this is not something I say lightly. I usually, for most of my career, used to refrain from making multi-annual predictions because I always thought as a political analyst, you can see maybe 6 months, 12 months into the future. But frankly, right now, the trends and the data that we're looking at is so clear that this level of geopolitical risk that is out there is going to continue to increase, and that I'm comfortable in making this prediction that we're just going to see a lot more geopolitical risk. We are currently the world order is changing. That is creating a lot more messy competition, a lot more risk. We don't know yet where it is going to settle. But what is clear is that the time of great power competition is back. And that this means that governments have to think very differently about their priorities, because now it's about protecting yourself. And this means, in some cases, painful trade-offs. And now think about, I think we saw the biggest annual increase in defense spending since the end of the Cold War last year. It was a 10% increase. And this was before the new NATO announcement came along, which in itself means that Europe has to rearm. Germany is rearming. It's becoming a geopolitical power, has to become a geopolitical power again by default. And that is creating a very different geopolitical reality. The US is, losing out on its unipolar moment. And we have a lot more aggressive, competitive multipolarity now. And so the security now trumps most other priorities. And clearly that is changing calculations. It's not anymore about cheap, efficient, we all have the same interests. We have many countries now have competing interests, even those that were supposed to be allies. When you look at the tariff announcements, between Japan and South Korea and the US, for example.
So you said a little while ago that you were sort of thinking about sort of historical analogies and sort of, I think you called them geopolitical regimes or whatever, and what conditions that might apply in those situations. I mean, everybody's always reaching for analogies. Is it the 1970s? Is it the 1930s? Is it, some other period? I mean, what is helpful in terms of trying to understand the current moment about looking back, and where do you tend to look at when you're trying to make those comparisons?
This is a great question. I frankly feel that since the beginning of this year, my time horizon of looking back has gotten bigger and bigger and bigger. It is really quite staggering. We're talking about mercantilism again, okay? This is the early years of colonialism. This is when you used to take trade as a way to extract more from your competing powers. Now, I think there's not one period that is a good image for what is going on right now, because the world is in a very different position. I think there are many periods, right? So when you think about the post-Second World War world order, we moved from wars to bipolarity to unipolarity, and now we're moving to multipolarity. The very fact that the US was the hegemon has allowed many other countries to rise. These were countries that have a much, much longer history of civilizations than the US. They will no longer want to take the rules that the US dictates. So that creates in itself, right, more competition and risk. So that's why it's not easy to give you one period. However, what I can give you is the results of our analysis, which is we grouped geopolitical conflicts since the 1920s to today. And what we can clearly see in those lines that our beautiful chart came up with is that the peace dividend that we saw since the end of the Second World War has come sharply down at the beginning of this decade, while the conflict patterns that were prevalent in the 30s and the 40s are coming up sharply, okay? And the thing is that this is not just our data that is showing that. I've come across other data that tries to measure the health of the global system with, things like the level of democracy and battle deaths. They kind of come to similar conclusions that we are in a historical, difficult moment at a turning point, really. We just don't quite know in which direction it's going to go from here.
Yes, that's right. And of course, I mean, to your point about sort of, the bipolar sort of Cold War era, then the unipolar US moment, and now potentially a sort of, a competition perhaps between the US and China. To the extent that comes about, people talk about the Cold War, but that's not really a helpful analogy, because the USSR and the US were never sort of economically integrated in the way that China and the US are. So I guess I wonder I think a lot of the time what I find myself thinking about is what are the examples where these economies have sort of pulled apart in a way that has left them both worse off, but they've done it anyway.
So this is, again, I think, a very important question where we don't really have much historical analogies, because we usually great power competitions have most of the time resulted in direct war, okay? With the exception of the Cold War, because we had the nuclear weapon. And the nuclear weapon had the so-called overkill effect, which makes it so disastrous of an outcome that powers shied away from that. Instead of direct war, you then had a lot of proxy wars, especially in Africa, as a result of the Cold War. We know now from things like the Cuban Missile Crisis that there were instances where nuclear war was not that far away. Okay. So when we now look at the situation with the US and China, there are a couple of conclusions that we can draw. Firstly, this is a great power competition. It's going to get worse because the US is trying to contain China. China's nationalism today is deeply rooted in the century of humiliation. They do no longer want foreign powers to influence what they do. And ideally, over time, as they get stronger, they will likely want to see US influence moving out of the Asia region, right? Because ultimately, this is about controlling the seas. It's about controlling waterways. And the US is very much out there in China's backyard. And ideally, China will want to push them back. So this is one point of contention. The other point of contention is that China is catching up in quite a few areas with the US. So there is a lot of potential for conflicts and for things to go wrong. Yet importantly, as you rightly pointed out, there is a huge economic dependency too. And both sides ultimately do not benefit from a direct confrontation. They don't, because it's the worst outcome for both, right? Nevertheless, the current environment is causing them both to increase their defensive capabilities. And the defensive capabilities, the other party will see it as offensive capabilities. So the risk inherently will continue to grow. And the question is, what happens then? I think we could see a grand detente ultimately emerge at one point where both say, okay, fine, let's stop here. We now peacefully coexist. But there is clearly a risk that we have to be aware of that this could escalate. But as of now, and as of the near term, this is in no one's interest.
Yes, and I suppose in a sort of limited way, that's what you saw with China and the US with the tariffs, where Trump introduced the tariffs, then they retaliated and they escalated, and they got to a point where it was completely ridiculous. But after a few weeks, then they basically kind of climb back down some of the way, at least. So back to your point about constraints, it suggests that there are still these constraints.
There are constraints, but we also have to be, see that there are big changes underway at the same time, because ultimately, we expected those tariffs to come down. Simply, as I said, it was in no one's interest. Nevertheless, when you look now at the deals that the US has signed with the UK, with Vietnam, that is likely going to sign with other countries, they all include an element of sidelining China, of penalizing countries for doing business with China. And China has taken notice. And there has been a big difference this year, which is that China has found a way to flex its muscles in a way that have intimidated trading partners, which is limiting its rare earth exports, where it has a huge advantage, right? And what is going to happen next? Those deals that are currently being agreed on are not finalized. They are starting points for more negotiations. So the more clauses are in those deals about sidelining China, the more China is going to get active and try and convince countries to not implement those clauses around China, right? So I think we're going to see a lot more tension increasing with China. And then many countries in the vicinity to China, like in Asia, what are you going to do? Are you going to depend? Are you going to do what an unreliable ally tells you very far away? Or are you going to make sure that the country that is closer to you and is a growing superpower doesn't squeeze you? So I think this is a kind of tension that we will see playing out.
It's really interesting. I just want to come back to what you were saying earlier on about financial markets and the sort of weird sort of calm in financial markets, given everything that's going on. As you said, people are basically focusing on what's actually happened versus what might happen. So what would, I guess the question is, what would change that thinking? It would have to be something sort of quite concrete that actually got implemented in a way that would surprise people, which would then cause some kind of market reaction or some adjustment in terms of the thinking. Is that the way to think about it?
So firstly, I think that the market is already very much reflecting geopolitical developments. So just think about gold prices. Just think about defense stocks. Think about the tech stocks. That is great power competition playing out. Think about the delays that we saw earlier about lowering interest rates. Those were in response to political developments. For example, when we saw the disruptions in the Red Sea and the concerns over inflation going up again. So geopolitics is already very much reflected in the markets. But in terms of like big imminent movements, I think at this point, probably it would be much bigger concerns about the US fiscal position or a real big economic hit from the tariffs, let's say major tariffs on the European Union and predictions of what this could mean for growth. Ultimately, that is the comfort zone of markets. And if there's a forecast that a recession would happen, then you would see a much bigger move. That would be my expectation.
Okay. I know I'm tempting you into making predictions, although obviously it's part of your job. So I feel okay about doing it. I mean, just to round off this conversation, I mean, what are some of the things that are on your radar screen that maybe we haven't talked about yet that the people aren't paying attention to, or as much attention to, and that maybe you think are being neglected, or that people should be focusing on?
So firstly, it's absolutely my job to do predictions all the time, to the degree where sometimes when I know I shouldn't be making predictions, I feel compelled to do them anyway. In my personal life, for example. No, but in general, I think that I don't think there's many things that are hiding in plain sight. Ultimately, you cannot predict a black swan event. A black swan event is by definition unpredictable. What I think is currently falling off a little bit is the situation in Iran and Israel, because ultimately for Israel, this is still unfinished business. We don't know what nuclear capabilities are still left. And the fact that you have a more hostile regime in place now is a problem for Israel. So I think this is not done yet. Mm-hmm. There are still many, many question marks over North Korea. We expected a bigger risk emanating from North Korea last year. This has not materialized, and it's been oddly quiet. But this is something that we need to keep in mind, especially as we have, this changing alliances going on. And I think that is an important factor too, that essentially the US has pushed Russia and China closer together. And North Korea plays a role here too. Iran too, although Iran is weakened now. And that has created I wouldn't say an alliance, but an opportunistic friendship that has common interest and more power now. And I think that's something that we have to pay attention to as well. So those are a couple of the bigger, longer term things that we have to keep attention on. What's happening in the Arctic as well, with melting ice and new trade routes opening up there and resource competition. I think that's an important factor. Also because it's opening up new routes for Russia and China to reach the US, which is again changing the geopolitical status quo altogether. So that's an important factor too. And frankly, the combination of all of these factors and the seismic shift that they represent, I think that's not quite that. I don't think we quite see that. And we always think, oh, Trump is tackle. And ultimately, nothing will change. And I think that is a little bit of a misconception.
Okay. Well, there are some, I won't say we end on a positive note, but there are certainly some things for people to, maybe some things for people to worry about if you weren't already worried. But I guess that's the nature of the job. Anna, this has been
I'm going to make it worse.
Okay.
When I'm wrong, I'm usually have been too optimistic. Okay. So it's not necessarily the nature of the job to just see the risks. I think, and that's very important, geopolitics also is a lens through which to spot trends and opportunities. And for example, what I've been speaking about, like defense, gold, when we saw this way back, because you can see these things emerging and therefore it becomes an investment opportunity, right? So and then it's not just about risks. Geopolitics is changing how we make decisions on a day-to-day basis, how our governments make decisions. And I think that's how we need to look at it.
Okay. This has been really fascinating. We could talk for a lot longer, but we're out of time. So we'll have to leave it there. But Anna, thank you so much for your time on this. Really fascinating. And we'll come back and see how some of your predictions panned out at some point in the future.
Thank you. It's been a pleasure.
That's our show this week. Thanks to Anna for joining us, and as always, thanks to you for tuning in. This podcast was produced by Oliver Tasich in London. You can listen to a new episode of The Big View every Tuesday on the Reuters app or your favourite platform. Don't forget to check out our sister podcast, Viewsroom, a lively conversation between Reuters Breaking Views columnists, as well as the other great podcasts from the Reuters team, Reuters World News and Reuters Econ World. If you liked what you heard, please follow The Big View and leave a comment to let us know what you thought. And don't forget to check out our views on the biggest stories in business and finance every day at breakingviews.com and reuters.com.